Well, welcome to our High Rock weekly video. As you may presume by looking at us, this is the holiday-ish edition and will be our final video for 2017. I'm Scott Tomlinson, and joining me is my partner and colleague and the founder of High Rock, Paul Tepsich, looking very festive in his ugly sweater. But you certainly can learn more about us on our website at www.highrockcapital.com if you are a first-time listener here. Well, Paul, it's been an interesting year.
It always is.
I would say that many forecasts from last year failed to ring true, and some outperformed. I think certainly stock markets did a little bit better than we probably would have expected them to do.
Around the globe.
Around the globe.
Not so much in Canada.
Yeah, exactly. Case in point.
Which is really interesting. One thing I just thought about too. Canada has probably, over 2017, certainly in the first half of the year, had the highest GDP growth of any developed nation. And yet our stock market was the worst performing stock market in the world. Kind of interesting.
Mm-hmm. Well, interesting, very interesting, in fact, because global stock markets had about an 18% year over year total return, and that includes any dividends that might have been paid as well.
Yeah.
Whereas the TSX was up on a total return basis about 8%. Yeah. And so when we break that down...
And most of that over the past 2 months.
Absolutely.
It was down on the year.
Absolutely.
Up until September.
And the good news of that is that we did do some buying.
We did a little bit.
Of the TSX ETF in September. So we did catch a little bit of that, which is good. But more of a case in point, when we look at these benchmarks that we do look at to compare what we've been able to accomplish over the course of the year, and not just 1 year, but multiple years, we do see that the global equity market has been a major contributor to growth over the course of this year. Certainly the TSX underperforming, as you said, and bond markets, especially in Canada, also underperforming to a degree. Now, again, bond markets have picked up a little bit in the latter part of the year as contributors to an overall portfolio.
Yeah, which is interesting given that stocks have actually rallied, bonds have rallied as well, and we normally don't see that.
True enough. Now, on that note, let's talk about our models a little bit. Perhaps we can start with what we've been doing over the short terms over the course of the last week, and then maybe talk a little bit about what we might foresee coming down the road.
Two changes over the past week. One was in fixed income we talked about last week. We sold our entire weight in 10-year Government of Canada bonds. We had a target to buy some in. We bought in half, thankfully, because the market did rally or improve even more, where bond yields went down and prices went up. So we had a pretty good purchase in there, and we'll try and be a little bit more patient for the other half. So that's within the fixed income model. Tactical, and we've talked about it before, we added to a position in a stock, which is Sherritt, which is our play on cobalt. Cobalt is an element, a byproduct of copper and nickel mining, and Sherritt is a nickel miner. Our view here is they're going to be doing a streaming deal sometime in the new year on their cobalt inventory, and I think that's going to be very good. So we did actually we bought we owned some bonds in Sherritt, but we bought more of the stock last week as well. So we've got a decent average price on this stock. I think that's going to be a pretty good position. And just one thing in general, we are seeing some sort of heaviness in a lot of names that are down on the year, and I think some of that is just related to tax loss selling, which I don't think is a really good way to invest, but nonetheless, it is a reality, and that's the way a lot of advisors manage money. So
sure, and just to expand on the tax loss selling, what tends to happen is investors who have registered capital gains in their portfolios that are realized capital gains will have to pay tax on those capital gains in 2018. So before the end of the year, they look through their portfolios, look for things that may have gone down so that they can sell them. Now they have to, they can't buy those exact securities back in within 30 days. But what they can do is buy a proxy for that particular security. So they may sell a security that's taken a loss over the course of the year and then buy a proxy so that they're not out of the market completely. And that's what Paul's talking about when he talks about selling. So some of the things that are already down get pushed down a little bit further.
Yeah.
Okay. Busy week this week for central banks. Last week we did see the Bank of Canada. They kept policy unchanged. We did see some caution in their press statement. We buy why they see that. Certainly there's things going on that are making them somewhat concerned. I'd say a lot of that is in the geopolitical sphere, and I would say NAFTA is probably a fairly significant part of that, the uncertainty there.
And those 10 years we bought last year was just before the bank announcement. So, and then we have the Fed tomorrow as well.
We do, and we just recently saw the U.S. employment growth situation. Interestingly, the month-to-month numbers very similar to the month-to-month numbers that we look at for Canada in the U.S. as well. They're very erratic. So we do look at them over a longer time horizon to get a sense of the trend. But the trend has clearly been lower as far as employment growth is concerned since the peak in early 2015. So that's, I'm sure, something the Fed keeps in mind. Always, we in the past, we've talked about what will potentially constitute a recession following the unemployment data, which has, for the second month in a row, stayed at 4.1% in the U.S. That 3-year moving average has come down to 4.9. Historically, when those two intersect and the unemployment rate crosses up through that moving average,
nothing good happens.
A recession tends to happen, but yes, you're right. It's not good.
Nothing good happens. And wage growth has not been accelerating the way the Fed would like to see it, and I think that's why the Fed and other central banks are kind of raising rates very cautiously here. So.
Although, that being said, the Fed is expected to raise by 0.25% tomorrow, so that will not be a surprise.
No.
And of course, as central banks do raise interest rates, and we'll talk about this just in a second, but as central banks raise interest rates, it draws liquidity out of the system. And that liquidity has been what's been firing and forcing equity markets higher. So, again, some caution that we're going to see going forward. But currently, with that employment data, GDP growth is expected to come in at this juncture for the fourth quarter, somewhere around 2.93%. Mm-hmm. So let's talk a little bit about what's coming as far as central banks are concerned, because we do see, and other economists are counseling, that interest rates will be moving higher, short-term interest rates moving higher. We've talked about this a fair bit in the past, but with short-term interest rates moving higher and inflation remaining relatively subdued. Now, it's a debate about whether or not inflation will pick up on a global scale with better economic growth. At this juncture, though, we haven't really been seeing much of that.
Well, that's the issue, and I think the path to least resistance could be for rates to stay lower for longer and inflation to remain subdued. I mean, everybody since a year after the credit crisis recession, people were looking for rates to go up and up and up, and they really have gone nowhere but down. So I think the path of least resistance on rates could still be down, and that chart shows us the expectation is still higher, as does this, quite frankly.
Well, and that's with certainly the Fed leading the way as far as raising rates. So there are a number of different schools of thought around what the Fed will do next year. Some say 2 quarter-point increases. Others have said as many as 4.
And what's really important is the part of the curve that you're invested in, whether you're at the front end of the curve where you may get hit by short-term interest rates going up, or you're at the back end of the curve in the 10 or 30-year bucket, where rates could in fact go down, which they have over the past year.
Exactly.
So that's helped your portfolio.
Exactly. And I actually did write a bit about on a blog on that last week. If anybody has not yet seen it, that's out there for your edification. Of course, we know that when yield curves do flatten, so as historically, as they have seen short-term interest rates move higher, lower long-term interest rates tend to mean that we're approaching a point where the economy is likely to slow as a result, and that's historically significant. Okay, well, that's what's going to fuel what we think economic situations, and ultimately on the back of that, somewhere we think in the middle will be some economic growth to the tune of somewhere around 2.5% in the U.S. I think, and not so different in Canada, maybe slightly less than that in Canada. But a lot of what we've been reading or hearing about has to do with this tax reform. Still not finished yet in the U.S., but even if they do get it pushed forward, Paul, you were telling me earlier that it's not going to be that significant necessarily for some companies.
It may in the market, but I was reading an article last week on the Dow 30 and looking at all 30 components in the Dow and their marginal tax rates. And there was one up around 40% and one around 35% or something. And they were outliers to the high side. But the bulk of these companies have marginal tax rates that are already at or below 20%, which is what's trying to be put forth through Congress. So, I think a lot of that is built into the market and may not have as big an effect.
Well, at this juncture, analysts are expecting about 11% growth rate for earnings in the S&P 500. So, on a 2.5% economic growth, 11% seems to me to be just a bit up there.
It's 4 times multiple.
Mm-hmm. So that leads us to what we think will happen as we go forward over the course of the next year, especially in equity markets. And as the U.S. equity market is about 50% of the global equity market, we will try to determine what we think makes sense as far as a risk perspective for our portfolios and very specifically for our global equity portfolio. We think that, and we have thought that all of the good news is built into the markets, and some of the bad news may be just sort of a little bit on the sidelines for that point.
Being ignored.
Being ignored, for sure,
to a degree. Geopolitical risks, et cetera, et cetera.
So based on that, the analysts expect to see somewhere in the vicinity of 5.5% growth from where we are today to next year. Interesting statistic is that analysts historically, over the last 15 years, have overshot their estimate by about an average of 13%. So our view, I think, is that because good news is all built in, some of the bad news not necessarily so. Analysts being a little too over positive going forward. I think there's a very good likelihood that we see a correction somewhere through the course of the next year. So it wouldn't surprise us to any great degree to see about a 15% pullback in the S&P 500 over the course of 2018. Of course, all of this is important only in regards to what we're doing with our global equity portfolio. We have our model. We also have the fixed income model. We have our tactical model. We're working very much to discover and find opportunities that we will utilize to get good and lower risk, longer term growth in our client portfolios. And that's really the work that we do here, is to try and be able to get good risk-adjusted returns for our client long-term portfolios. Paul, anything to add?
Merry Christmas, Happy New Year.
And from me as well. So we wish all of you the best of the holidays, and we wish you a very happy, healthy, and prosperous 2018, and look forward to updating you as we begin the new year in January.